Hi, I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have with us here today Jeffrey Small, book author of Turning Financial Planning Right Side Up. Jeffrey, welcome to Traders Nation. How are you today?
Hey, I'm doing great. Thank you for having me.
You're more than welcome. Thanks for being with us. Hey, what brought you to write Turning Financial Planning Right Side Up?
Well, you know, the book really was a consumer advocacy book, and it teaches people how to master the inside game. And really, the media bias and the bias that exists in my industry really is what motivated me.
Yeah, how do folks get through that media bias? I mean, you know, today media is on the front page of everywhere when it comes to potential bias is what they're saying. How do people wade through that and find out a good source to get that information they need to make sound decisions?
Well, you know, it's really hard. If you trust the media to manage your money, you're going to be in trouble over the long haul. But but really what you want to do is develop some insight and some education, and my book provides the platform for that insight because there's information for the classes, Kurt, and there's information for the masses. And we really focus on the insightful information that we don't hear about in the media that affects folks and what they really need to think about as it relates to their own situation, because everybody's situation is original and different.
Yeah, it sure is, isn't it? So let me ask you then, so when it comes to You talk, I'm in Wall Street right now. I mean, look at the Dow. We're breaking records left and right. But morally bankrupt still. Wall Street's really had a bad reputation over years. I don't know how long, decades as far as I can remember back. Is it going to really kill the American dream?
Well, you know, the next correction probably will, because for a lot of us, we've lived through the last 17 years with two epic drops, and now we have this catastrophic rise. Yeah. And so a catastrophic rise usually means there'll be a catastrophic collapse again at some point, but it really remains to be seen. But for now, the market's bullish, at least for now until the Fed raises rates and kills the market.
Yeah. So certainly, what's propping the market up right now? What do you think? I mean, is it just euphoria? I mean, is it just some...
Well, what's really propping up the market, part of it was the optimism from Trump and the Trump bump and having a pro-growth, business-minded person in the White House. That really sent sentiment to the roof from consumer perspective and from business perspectives, and the sentiment is still very high. But what's really the riskiest component of the market right now, Kurt, is investor sentiment. It's not a particular company that's driving the market prices up so high as much as it is a low-rate environment. There's no place to make money, so we got to go into stocks, so let's buy.
Yeah. All right. So what if certainly I agree with you. At some point the market is going to get overextended like it always has. Make a correction, maybe even a healthy correction, but certainly that scares people. So what's one good way, or maybe several good ways, that folks should what's their posture? What should it be to make sure that they don't take a hit like they did
Kurt,
back in 2009?
that's very interesting, because that's exactly what we discuss in the book. How do you net 5% or greater for the next 10 to 15 years? And there's a chapter in my book called The Goldilocks Zone on how investors should be positioned and postured, especially for folks over 50, over the next 10 to 15 years. Where is going to be that sweet spot? And we cover that fairly extensively. Yeah. But the name of the game is if you want to outperform the market, you've got to avoid the downturn. That's the first thing you've got to do.
Okay, and again, give us what would be a good example of avoiding that. Is it your positions? Is it keeping a certain amount in cash? Is it the type of equity? Is it due diligence? Would it be watching the market every tick? What would it be?
Well, let's prioritize it. The first thing is, somebody has to understand as an investor, if they're managing their own money or working with Fidelity or another firm that has a broker, you have to understand the effect of risk on your money. What happens if the market drops 20, 25, 30, 35% on your money? What does that do to my portfolio while I'm withdrawing money? How are fees impacted? The book tells you how to measure and model that yourself. And then secondarily, you want to make sure that you've got the opportunity to be balanced and modernize your portfolio to reflect the state of the markets. Now, we know we're in a very slowly rising rate environment, which means it's going to be painful for things that produce income, fixed income components, whether it's preferred stock or bonds or some other fixed income component that's in the marketplace that we have today. As rates rise, those prices are going to gradually drop. And as the market moves forward and is still bullish for probably the remainder of the year because of the tax cuts, then what's going to end up happening is we're going to find ourselves probably in 12 months where there's going to be a huge exodus out of the market back into fixed income. because those prices are going to be very attractive. So you've got to be able to modernize your money to reflect the current state of the markets, and it's all about modernization, not burying our head in the sand and just hoping. Hope's not a strategy.
Yeah. All right. So as the Feds make their rate hikes, and they're going to do that, they've had them historically low forever. Okay. Strategy when it comes to those Fed rates should be maybe circling back with your portfolio and maybe adjusting that. Is that safe to say, Jeff?
I think it's very safe to say, and so it's very possible for folks to get there's a menagerie of investments we talk about in our book that have yields and dividends and interest of between 4% and 7% consistently every year. So for the folks that don't want risk, they can gravitate into those. Yeah. For the folks that want balance, they should have a little bit of fixed income now, as well as some growth-oriented components, because the market is going to be bullish for quite some time, at least for the remainder of the short term, let's say 12 months or less.
Sure, and let's face it too. I mean, 4 to 7%. That's a pretty good return if volatility hits the market. I'll take that. I'll take that over putting it in cash, because some people think flight to quality is cash, and I don't know if that's necessarily the case. People want to get out. That's that knee-jerk reaction. Let's get to cash. What your thoughts on that?
Well, Kurt, you just nailed it. That's exactly why the book is so vital for folks to pick up, because it shows them how they can get that 4 to 7% and not be market centric. Because if you have an account at Fidelity, they're not going to tell you how to do that. If you have an account at another major wirehouse firm, they're not going to tell you how to do that. My book does tell you how to do that. It's very easy. Anybody can do it. You can work with an advisor, or you can do it yourself.
Okay. You also talk about American financial sector as the largest developed in the world, and certainly it is, all right? But our school system, they're not really teaching financials in our school systems. Where does that need to come? Are we talking about let's start at home?
Well, I think a lot of that starts at home as far as teaching kids about money, especially it does with my children. But I will tell you, there is zero financial education and career development in public schools today. It's really awful. If you don't go to college, you're in big trouble.
Right. All right, so I certainly have done that. My boys, they've got Ross. I put $50. I help them put, they do, when they're working. They put $50 away in a month, every month, into that Roth, and they did it early. So I think it's very important to start early when it comes to personal financial, and for your kids to learn that, because they simply aren't teaching that. And you actually have some information in Turning Financial Planning Right Side Up about that. So I think that's another great reason why folks should get a copy of it. All right, so let's go to the bull market. We talked about that earlier, right at the intro, the part of the show. Do you think that at some point, losing steam as we go on to 2018, in tandem, as the Feds increase their rates, which I think is highly probable, do you think that momentum, that steam, is going to be lost as they do that?
Well, I don't think. I think it's going to be benign, to be honest with you. There's so much economic activity right now and inertia of money supply in motion that I think the Fed. The Fed raised. They went through 17 straight quarters from 2004 to 2008 of interest rate increases, and they could not slow down the economy. And we're in that same mode again. Yeah. And so the only way they could really put a damper on it is if they had a rate increase that was greater than 0.25%, which is what they're projecting. They're going to have 8 straight quarters of 0.25% increase. Yeah. If they go larger than that, then that could dampen the economy and hurt the markets.
Do you think they're going to do a big one? Because I don't know if they really want to get in the way. I mean, we've really had some stagnation over the last. We're out of time. All right, listen. Jeffrey, where can we get a copy of Turning Financial Planning Right Side Up today?
Well, obviously it's on Amazon. It's on the shelves at Barnes & Noble, but it has a website called financialplanningrightsideup.com with links directly to Amazon from there.
I wish we had more time. Hey, Jeffrey Small, thanks for being with us today. Turning Financial Planning Right Side Up. Get a copy today. We'll be right back. Thanks.